Hi, we are going to have a quick look at the Vasicek model in terms of measuring capital for credit risk. Now, a quick introduction. So, the Vasicek model is proposed by regulators to calculate capital for loan portfolios. And when we talk about the Vasicek model, there are a couple of things that you need to understand before we go into the model itself and how the model is used to calculate the probability of default of a particular loan portfolio. So it uses the Gaussian Copula model to determine correlation between defaults. Now, if you are not aware of the how the Gaussian Copula model works, I have done another video. Basically what we are saying is there are two variables. The distribution of the variables are unknown. So these two variables, for example, they are not normally distributed. Now what we are saying is even if the individual variables are not normally distributed, you can transform each of those variables into a standard normal distribution. And by transforming them, if we take the joint distribution of these two variables, u1 and u2, then the joint distribution will also be a standard normal distribution, which is quite helpful to analyze, because when the individual distributions are not known, it's very difficult to estimate the properties of those distributions. So that's at a high level what the Gaussian Copula model talks about. Of course, I've discussed a bit more details in a separate video. Now, so when we talk about the Vasicek model, the Vasicek model assumes that the variables follow a Gaussian Copula model to determine correlation between defaults. Now, one thing to emphasize, the reason that we are using a Vasicek model is, remember, when we calculate the capital of a particular loan portfolio for credit risk, one of the most difficult components is to calculate the worst case default rate. In other words, just think about a loan portfolio where you have 2,000 individual corporate loans. Now, what would be the worst case default rate for the whole portfolio? Because, for example, a bank would have lent money to various firms, firm A, firm B, firm C, etc. How, firm A can default, but when firm A defaults, how is that going to affect firm B's default? How is that going to affect firm C's default? And therefore, how it's going to affect the whole portfolio's default? Because we know if there is an economic impact, most firms will default at the same time or at least during the same period. So that's what the Vasicek model is mainly interested, how to calculate the portfolio default rate. So also we are saying it's used to measure the unexpected loss, and the unexpected loss can be estimated analytically using the Vasicek model. Rather than just picking a number, you can estimate the unexpected loss analytically. So there are a couple of assumptions we use when we use the Vasicek model. Now, the model assumes all loans have the same correlation in a portfolio, which is quite trying to simplify, because think about it, if you have 1,000 to 2,000 different loans and you're assuming or you're going with a different correlation between each and every loan, the model is going to get quite complicated. So what we are trying to say is that the model assumes that there is the same correlation between loans in a particular portfolio. Also, the model assumes all loans have the same probability of default. In other words, the model assumes that averagely, you can loosely say it like that, averagely, each and every loan in the portfolio has the same probability of default. So remember, When we are talking about the Vasicek model, what we are trying to do is we are trying to use this model to calculate the worst case default rate of the loan portfolio. So that's quite an important thing to remember. Now, this is a formula that we use when we have to calculate the capital requirement for a bank that uses the internal rating based approach. So this is the worst case default rate with a 99.9% default rate in the distribution. Now, PD is the probability of default. In other words, the average probability of default. So remember, we said that we assume, the model assumes all loans have the same probability of default. So this is the, basically, for example, you can say that we assume each loan has a 1% probability of default. So that's this component. This is the lost given default. In other words, if a default happens, what percentage of the loan will not be recovered? The loss given default, which is 1 minus recovery rate. So if, for example, if we assume that if there was a default and the bank can recover 75% of the loan, then the loss given default is 1 minus 75%, which is 25%. And then finally, this is exposure at default. So exposure at default means simply the notional that's exposed at the time of default. So for example, if you have a loan with 10 million outstanding, exposure at default is 10 million US dollars. But remember, this is at a portfolio level. So the whole concept of the Vasicek model is that we are trying to calculate what's the worst case default rate of the loan portfolio. That's what the Vasicek model is trying to calculate. Now, before looking at some of the formulas in the Vasicek model, it's important to understand when we talk about the Vasicek model, the Vasicek model assumes that each loan has a systematic factor. So here the F is a common factor or a systematic factor. You can think of as a economic factor. So each loan is related to a systematic factor and an idiosyncratic factor. So in other words, if I give you a very simple example, let's assume that there's a technology firm. So the default of that technology firm, or the expected default of that technology firm's exposure, is linked to a systematic factor. It could be the unemployment rate or the interest rate of the economy. So that's a systematic factor because that will affect all the firms in a particular economy. And then you can have an idiosyncratic factor. In other words, it's very specific for that technology firm, maybe how the products will sell, or maybe the approval of a particular license, some sort of an idiosyncratic factor. So when we use the Vasicek model, this is the assumption that a particular exposure is linked to a systematic factor and an idiosyncratic factor. And here the A is basically the correlation between two loans. So A is the correlation. So remember, in the Vasicek model, we use the Vasicek model to calculate the worst case default rate of a particular portfolio. So in the portfolio, you will have many loans or many obligations. And this UI is basically the sum of two independent normal distributions. Remember, we said the Vasicek model assumes a Gaussian Copula model. So what that means is this can be your individual loans loss distribution. Now remember, when we talk about loss distribution, what we are basically simply saying is that the probability of loss in 1 year. So here I'm just showing you a diagram. You could make a loss. So here the losses are quite low, and you can see the average loss, the probability of making an average loss is quite high, but having a large loss, the probability is quite low. Remember, the probability is covered by the area of the curve under the area under the curve. So the probability of making a large loss is quite low because this area is quite low. You can see that. So that's what we are saying here. So when we talk about U here, the U is not the actual loan itself, it's transformed from the loan. You can see V1 and V2 are the actual loss distributions of the individual loans. They are transformed into U1 and U2, which is the Gaussian Copula model. And then what we are saying here is that once we join these two standard normal distributions, that's what we are saying here, sum of two independent normal distributions. So of course this is a norm, this variable is normal with a mean of 0 and a standard deviation of 1, and this variable is linked to a common systematic factor and an idiosyncratic factor, in other words a factor not correlated to other factors. So loosely we can say, when we talk about a Vasicek model, it assumes that each obligation is linked to a systematic factor and an idiosyncratic factor. Now let's look at how the Vasicek model uses, how does it calculate the worst case default rate. So if you assume that this is a default distribution, remember when we talk about default distribution, what we are saying is what are the probabilities of a particular portfolio defaulting. Now, and of course with a very high 99.9% default rate. In other words, we want to know that if a particular default happens, with a very high confidence level, 99.9%, how much the loss is going to be. So what we are saying is we want to find in this diagram, you can see that this is 0.1%. Let's assume that this area is 0.1%. So that means this is where a default could happen, and anywhere else there is no default, because we are looking at the distribution with a 99.9% default rate. In other words, what are some of the worst outcomes we can have if there was a default. So this is 0.1%. Assume that this area is 0.1%. So this is where a default could happen, and anywhere else there is no default. So this is the 99.9% of the curve. Now you can link a default rate as a function of the economic factor. Remember, we said when we use the Vasicek model, we assume a particular obligation. Of course, U is not just a particular obligation, it's the joint distribution. So we are loosely defining this. We can assume a particular obligation is linked to a systematic factor or an economic factor and an idiosyncratic factor. So when we calculate the worst case default rate using the Vasicek model, we can calculate the default rate as a function of the economic factor, in other words linking the economic factor. So this is the formula that we can use when we calculate the default rate as a function of the economic factor. So this is simply the inverse, the normal inverse of the probability of default of an individual loan. So that's one of the inputs you can see for the Vasicek model, the probability of default of individual loans. That's one of the inputs. And remember, we said when we use the Vasicek model, we assume all loans have the same probability of default. So that's the first input. Then the economic factor is the second input. So this economic factor could be, any kind of common economic factors. And then the third input is we said is the correlation between two obligations. And remember, we said as part of the Vasicek model, we assume all loans have the same correlation in a portfolio. So those are the three inputs: the probability of default, the common economic factor, and the correlation between two loans. Now this formula here, when we calculate the worst case default rate with 99% 99.9% probability of default, it can be shown that this formula will become equal to this particular formula here. So n is normal standard distribution, and so this is the inverse of a normal standard distribution. So you take the inverse of the probability of default plus square root of rho. So rho is the correlation between each pair of loans. Now remember, this correlation, when we say correlation between each pair of loans, actually we are referring to the correlation between these two distributions. So when we say here rho is the correlation between each pair of loans, actually what we are trying to say is the correlation between the transformed distribution of the loans, because these are the actual loss distributions of each loan. So they are transformed into a normal distribution, and rho is the correlation between these two distributions. It's just a small technical thing that you should note. So remember that rho here is the correlation between each pair of loans of the transformed distributions. So that's an important thing to remember. And then the common economic factor can be written as an inverse of a normal standard distribution, because here we are trying to calculate the worst case default rate with 99.9% default rate. So what we are saying is, if the common economic factor drops to such a low level, then there will be a default, and that's what we are replacing this f here with normal distribution, normal inverse distribution of 0.999. So this formula is quite important to remember, because with this formula you can calculate the worst case default rate with 99.9% default probability. So here I'm just showing you an example. Let's assume that you have a loan portfolio and the default rate of individual loans is 1%. So that's the probability of default is 1%. And then you can simply take the inverse of normal standard distribution. Inverse of 1% is 2.326 minus, let's assume the correlation between each loan is 0.5. So that means rho is 0.5. So you can see here rho is 0.5. And then the inverse of 0.999 is 3.090, and then you divide it by root of 1 minus rho, 1 minus 0.5. So that gives us 42%. Now that's quite interesting, because if you see this, the individual loans probability of default was only 1%. You can see here probability of default is 1%. So you have a loan portfolio, the individual loans probability of default is only 1%, but the portfolio's worst case default rate is 42%. You can see it's very high, and the reason is because the correlation is quite high, 0.5. Remember, correlation can be between -1 and +1. So we are saying that loans are positively correlated and the correlation is quite strong. That means when one loan defaults, the other loan is going to default, and so on and so forth. Now, if the correlation is 0, in other words, every loan is not correlated to anything else, you can see that this component will become 0 because rho will be 0, and this component will be just 1. Root of 1 is 1, which means the worst case default rate with 99.9% confidence level will be just the probability of default, which means it will be 1%. So remember that if the correlation between each loan is 0, then the portfolio default rate is same as the individual loans default rate. But once the correlation starts increasing, your portfolio default rate with 99.9% default probability can be quite high. Here in this case it's 42%, and you can take this 42% and plug it in here, and you can calculate the capital requirement based on the internal rating based approach. Now the reason, if you look at here, just a small technique. Now the reason we are deducting the probability of default from the worst case default rate is because, remember, if you just multiply the probability of default by the loss given default and the exposure at default, what you get is the expected loss. What you get is the expected loss. Now, the capital requirement under the internal rating based approach is simply to cover this gap here. That means this is the expected loss minus, sorry, the unexpected loss minus the expected loss. So the capital requirement is to cover this gap here, the capital for the unexpected loss. So that's what we are saying here. If you see here, we are deducting the probability of default from the worst case default rate in order to calculate the difference between the unexpected loss and the expected loss, because we need to hold capital only to cover that difference. So the capital requirement for a bank that uses the internal rating based approach is simply that difference. So you need to hold capital just to cover this loss, not from here to here, just this loss. That's the reason we were deducting the probability of default from the worst case default rate. So remember, Vasicek model is quite useful in order to calculate the default probability of a particular loan portfolio. Of course, there are some assumptions the model uses when calculating the default probability, and also according to Vasicek model, a loan obligation has two components. One is a systematic factor and the other one is an idiosyncratic factor, and of course it uses three different inputs: the probability of default of individual loans, the correlation between loans, and also the economic factor. The moment we say that the worst case default rate with a 99.9% default rate, the economic factor can be replaced with this particular formula here, and that will help us to calculate the portfolio wide default rate, and then we can use that formula, this number in this formula, to calculate the total capital that will be required. So if you have any questions, just put it on the comment section, or any other observations, just let us know, and we'll be happy to help. Thank you.